we started the year expecting rates to maybe end 2025 around 4%. Probably, according to those market forecasts, it's going to be something like 3.5% now. Hello and welcome back to the Personal Investor Podcast. I'm here with Tom Stevenson, Investment Director here at Fidelity, and we're going to be talking today about interest rates, how they affect your finances, what moves them, and a little bit about where interest rates are in 2025 and where they could be headed in the future. So, Tom, welcome along. We're talking about the Bank of England here and the interest rates that they set, but I guess people might be wondering exactly how those affect the other interest rates that they see in their lives, on mortgages, on loans, credit cards, other things. How does one thing affect the other?
Yes, I mean the interest rate that the Bank of England sets is sometimes known as the base rate, and that's
Hmm.
the hint is in the name. It's the base on which other interest rates are set. It's the foundation for other interest rates. So if there's a movement in the base rate from the Bank of England, then that will tend to be reflected in the interest rates that are charged by banks, for example, on mortgages or loans or whatever. But the link is not always exact,
Yeah.
and it will depend on various things. One of the things it depends on actually is just how low interest rates are generally, because it's very difficult for interest rates to go below zero, because if you're not going to earn any interest on your money, then there's no incentive for you to deposit your
Hmm.
money with a bank. So as interest rates come closer to zero, then the difference between the level at which a bank will lend and the level at which it is paying out to savers is compressed, and so their profitability, which is essentially the
The
gap
difference,
between the two
yeah.
interest rates, gets squeezed. So as interest rates move away from zero, then the banks will naturally be inclined to widen their interest rate margin, their profitability. And so at times like that, you may get a bit of variation between the movement in the base rate and the movement in interest rate. So that's a long way of saying they're connected, but they're not exactly connected.
Yeah, and I think often people sort of bump into this. It's, they'll wonder, why does the Bank of England have any business changing interest rates and that affecting what a bank does? It's technically true, isn't it? That the base rate that the Bank of England sets, actually called the bank rate, just to confuse it again with more terminology, but the bank rate that the Bank of England sets, is a sort of interbank rate of interest. So commercial banks can deposit money with the Bank of England and get a rate of return. And then, because those commercial banks are in a competitive market, that's going to alter the margins they can make on what they lend out and what they take in deposits and the interest they pay. And so it's correlated, as you say, but it's ultimately up to banks and other savings providers, lenders, to set the rates that they put out there in the market.
Yeah, that's right. I mean, they're not obliged to do what the Bank of England does, but
Hmm.
just as you receive an interest rate from a bank when you deposit money with a bank, commercial banks deposit money with the Bank of England and they receive an interest rate. So
Yeah.
if the Bank of England pays them a higher or a lower interest rate, that will be an influence on what they subsequently do with that money.
Yeah, and of course there are some products in life which actually are very linked to the Bank of England rate. Variable rate mortgages, tracker mortgages, that kind
Mm.
of thing, often will move. You know, the as soon as the base rate changes, the rate on those products will change as part of the contract that you sign, right?
Yeah, that's right. I mean, tracker mortgages you mentioned there, they were very popular a few years ago, and they as the name suggests, they follow the base rate, so they would be base rate plus
Hmm.
0.5% or 1% or 1.5% or whatever it was. And so whenever there was a movement in interest rates, then those tracker mortgages moved exactly the same amount. So when that was the case, and when a lot of people had tracker mortgages, I think maybe fewer people have them now than used to be the case. There was a lot of interest in what the Bank of England was doing.
Yeah, and the lending. So borrowing on credit cards and loans and also savings accounts. That's the most sort of obvious effect. But actually, the interest rates that the bank sets can have all sorts of other effects on investment uh, assets as well,
Mhm.
can't they? Bonds in quite a direct way, but actually also parts of the stock market as well are affected by what the Bank of England is doing.
Yes, and the mechanism here is that there is competition for assets. So if an investor is able to receive an income of, let's say, 4% on a super safe deposit like a cash deposit, then that will influence their motivation for taking the extra risk of investing in a bond, or even more so, a share.
Yeah.
So movements in the base rate, and therefore movements in the risk-free return that an investor can get, will determine the likely payments on a or returns on a riskier asset like a share or a bond.
Yeah, exactly. And so and to confuse things again, you have interest rates within the bond market, and as you say, that's what the market is demanding as a return for the risk it's being asked to take. And because bonds are a little bit more risky than cash, those rates tend to be a little bit higher than the Bank of England rate, and the Bank of England rate changing then has a sort of knock on.
And of course, some bonds are more risky than other bonds. So a government bond, for example, is the least risky type of bond. If you're lending to a government, you can be pretty sure that the UK government or the US government, a developed country government, is going to repay their debts to you.
Hmm.
So you would require only a small additional interest payment over and above the base rate. If you were lending to a company, you'd require more of a compensation. You'd require a higher income for lending to a company. So the interest rates vary depending on the riskiness of the asset.
Okay, so that covers really why or how changes in the Bank of England rate are going to impact people's finances in all areas of their lives. But the question, I guess, is why would the Bank of England want to move interest rates at all? It's not just doing it on a whim. Why is it sort of moving these rates all over the place by changing the base rate?
Well, the reason is that it's the most usual, it's the most powerful tool that a central bank has to calibrate activity in the economy. So a central bank has well, different central banks have different mandates. Some of them have what's called a dual mandate, so they are required to keep inflation at a moderate level, and at the same time they are required to support employment in the economy. So that's true of the US Federal Reserve, for example. They have this dual mandate. They have to do both at the same time. The Bank of England actually has a slightly different mandate. It has what's called a hierarchical mandate. So its top priority is looking at inflation and making sure that inflation doesn't run out of control. It has a secondary mandate, which is to support the government's economic policy, which broadly means to
Grow the economy.
support the growth in the economy. So so most central banks are concerned about both inflation and growth, but in slightly different ways. The way they do this is by changing interest rates, because if you lower the interest rate, it makes borrowing cheaper, and it makes saving less attractive. So therefore,
Yeah.
it makes spending more attractive,
Yeah,
relatively speaking.
it leaves more money in the pockets of individuals and of businesses, and that's effectively extra demand, isn't it, in the economy? And so more activity,
Yeah.
but also potentially higher prices, because what you know about supply and demand is the higher the demand, you keep supply the same, prices are going to rise.
And if prices rise, if you have inflation, running too hot, too high, then the Bank of England will do the reverse. It will raise interest rates in order to cap the level of inflation. So
Yeah,
higher interest rates curb inflation, lower interest rates stimulate growth.
which is why some people can get frustrated with interest rates going higher when it means more money they have to pay on a mortgage or what have you. And it could be easy to wonder why exactly it's being done, but that is the reason. It's so
Mm.
that you head off some bigger problem with inflation in the future, right?
And let's not forget that different types of consumer respond differently to interest rate movements. So, if you are an older person who has paid off their mortgage, for example, and you
Yeah,
have savings, then actually you're quite happy when interest rates go up. If you're a younger person with a big mortgage, you want interest rates to be low, and that's part of the challenge for central banks, is that what they do will have different effect on different types of people.
yeah, and of course we covered this a lot when rates were going higher, sort of rapidly higher, 2 3 years ago. Um, a lot of people in the UK, at least, their mortgages are fixed for 2 years, but often 5 years, 7 years, 10 years sometimes. That means they're not going to feel in their mortgage, at least, a rise in interest rates. Actually, that's a consideration for the bank, isn't it?
Mm.
Because there's no point raising interest rates if no one's going to actually feel the rise.
Yeah, and also it's true that if you are in receipt of a state pension, for example, which is tied to the inflation rate,
Hmm.
an increase in inflation, and therefore higher interest rates, is actually a
Yeah,
positive for you. So it's quite a complicated area, and the job of a central banker is really very difficult.
yeah. Well, let's having covered the basics of interest rates and what they're there to do, let's turn to the here and now. It is May 2025. We've seen interest rates come down just recently. They had been, the Bank of England's rate at least, had been up at 5.25% last summer in July 2024. It's 4.5% as we speak and record today, but probably not for long,
Mm.
because we expect things to expect rates to come down again this month. Um, so let's get into some of this. First of all, what's been bringing rates down from that peak last year?
Well, we just mentioned that the link between inflation and interest rates, and what we saw in the last 2 or 3 years is a big spike in the inflation rate. Actually, peaked at just over 11% here in the UK, as a consequence of some of the supply chain constraints as we came out of the pandemic. So there was a big spike in inflation. The Bank of England's main job, as we've discussed, is to keep inflation in check. So they raised interest rates from a very low level, where they had been really for 15 years or so since the financial crisis, almost barely above zero. They rose them, as you say, to 5.25%. That had the desired effect. It reined in activity. Inflation started to come down, and inflation is now down at about 2.6%. Now,
Mhm.
there's a question mark over how long inflation will stay at that level, because there are various price rises have gone through the system in April. Some broadband charges, for example, some of the impact of the rise in the national insurance payments by companies is likely to lead to price rises, and therefore, so I think
Mm.
there is a general feeling that inflation at 2.6% is a nice place to be, but it's not going to last for long.
And still above target.
It's still above target, yeah, and indeed parts of the inflation calculation, wages, for example, and the service sector inflation is actually higher than that. 2.6%, sort of closer to 5%. So, the Bank of England has not won the inflation battle by any stretch, but it's nowhere near the 11% that it was just 18 months or so ago.
Yes, and when it's possible to kind of forecast with rates what's going to happen next, and that's not just a kind of finger in the air prediction. There are market prices, aren't there, in the bond market that tell us what the market collectively assumes will happen with prices. We don't need to go into all the technicalities
Mm.
of that, but those forecasts have been falling still. We knew rates were going to come down, but actually in the last month or two, where we think rates will settle has actually been falling lower and lower.
Yeah, yeah. I mean, it is complicated, and I won't go into the detail. But essentially, if you look at the bonds which mature at different points
Points.
in the future, 2 years away, 10 years away, 30 years away, they will have a different yield. They will pay a different income, and that income reflects, to a large extent, expectations about where interest rates are going to be
Yeah.
over that time period. So, if you expect interest rates to come down over time, and there may be different reasons for that. It may be that the economy is slowing or that inflation is more under control. Then, across that whole what's called the curve of those, if you plotted all of those
Hmm.
interest rates out into the future, it would come and it would look like a curve. That whole curve can move up or down. And what we've seen, what you alluded to there, was that the whole yield curve has come down a bit. And what that's saying is that expectations for interest rates are now a bit lower than they were a few months ago. And one of the reasons for that is there's a lot more uncertainty in the world around trade, around tariffs, and there is a feeling that is going to lead potentially to a slowing of the global economy, and the UK will be affected by that, just like many other countries in the world.
Yes, and it's been interesting to watch that sort of that happen. We started the year expecting rates to maybe end 2025 around 4%. Probably, according to those market forecasts, it's going to be something like 3.5% now. So that's a
Mm.
significant move lower, isn't it? For a long time, they were sticking at that high level, but it seems that the latest kind of changes and developments in economies means that we'll get more rate cuts. Um, Tariffs are part of that picture. We've seen, the application of tariffs in the US. Still, it's a bit uncertain as to the effect of those on the US economy, but that will have a knock on for all sorts of economies around the world, including the UK. Um, Potentially, those are inflationary. So, how is it that we're getting predictions of lower rates?
Well, they could be both inflationary and deflationary, not at the same time. But for example, one of the issues is that if tariffs are high in the US, countries which would otherwise have sent their exports to the US may choose to send them somewhere else. So China, for example, may divert some of the exports that it would have sent to the US to Europe. We could end up with a glut of goods from China, which would depress prices and the inflation rate. You know, within America, for example, where tariffs might have the effect of pushing prices up on imported goods, that could be inflationary. So again, there's a two-way pull here. It could be both inflationary and deflationary. It could be inflationary and then deflationary
Yeah.
if higher prices, cause people to spend less and activity to slow. You could get initial inflation followed by a period of deflation.
Okay. Okay. Well, I think that just about covers it, Tom. I'll remind people that if they feel like it, they can give us a like and a subscribe on the channel. It really will help other people find this content. But for now, thanks for watching, and Tom, thanks for joining me.
Thanks, Ed.